All right, I just wanted to do a quick video on multiples. I get a lot of questions about this topic, and I think it's a really probably one of the most important things for newer investors to learn is your going in price, and whether or not you think your multiple that you're using to analyze your company is going to expand or contract, or at least understanding the risk of either of those things happening or the benefit of either of those things happening, depending on what you're doing in the market. Um, we're starting with this picture of the 25-year chart of Cisco and the poor souls that bought somewhere in here and overpaid, and we just now, 25 years later, are reaching the same price. In this same picture, there is some opportunity where if you did not overpay and you waited, you had multiple years to enter the stock and potentially make multiple hundreds of percent on your way to where we are today. Um, for this video, we're going to just use Visa, nice and simple. Visa is generally valued by its earnings. A lot of companies are not, but Visa is a more stable company. You can see that since 2016, the earnings have compounded around 14%. You can slide this around and see, based on the years, like the ultra long-term performance. Um, on the front page, you can see that the current PE is around 33, and the forward PE based on projections of the earnings is 25, which is for Visa pretty low. And the reason we know this is low is we would look at the average price to earnings, and you can see that the average, let's go back to 2010. The average is 30.99, but as Visa grew, I want to use like maybe 2017 forward. The market pays up a little bit for this company because they have very stable cash flows. They're a very dominant, high moat business. So the average is at 33. And if you were to buy it today, you'd be paying for it right around the average, which means that you're hopefully not overpaying if the market's correct about this stock. Um, so the issue here is you can see over the history, many stocks around this time frame were overvalued, including Visa. So if you had a going in multiple of 50 and then your multiple contract to 25, whatever price you paid, you literally just got cut in half, which is crazy to think about. So if you bought then, you know, paid 230, you might have got, yeah, I mean, you can see it pretty much happened, right? The fundamentals continued to grow, but your stock price got almost cut in half from a contraction of the multiple. Obviously, fundamentals growing and the multiple changing are separate things, but sometimes the multiples follows the fundamentals or the stability of a business. And I think, choosing a multiple is kind of the hardest part about stock analysis. You never really know what the market's going to do. A company might fall out of favor. Its multiple might contract for a good reason, for stupid reasons, and that's where the opportunity comes into the market. So our little valuation model. So I forgot to show that. A lot of these, to just begin an analysis, I like to look at what the professional analysts are doing. So, there's 20 analysts covering this that we can pull through Stock Unlock. And the low, average, and high are each about $1 apart from each other. And actually, it looks like that. So you can go right to the analyst section to get the EPS for 2028. Remember, this is just 2028, so it's only 2 years from now that these targets are. A lot of more common models are 5-year projections, but let's just go with the 2028 thing. So If their EPS is 15.2 and the market's paying a 25 multiple, the price target is about 380, so a 9% move in 2 years, which is a little rough. 16.5 with a 33 multiple, which is right about the average. You're getting a 57% move for a very safe company that also has a dividend in 2 years. And the more bullish view is the market re-rates a little bit. You get some boosting of the multiple, and you get a 77% move, which is amazing. But what I want to show you here is, let's use the average middle range, and let's expand these multiples out. So let's imagine that, um, you know, let's imagine the fundamentals sort of stay stagnant here, and we're just viewing the multiple as how our price moves. You will see the drastic difference that can happen from even a multiple change of 5. 19% gain, 43% gain, 66% gain, all with the same EPS. And even something as simple as a multiple of 1. It's about a 4 or 5% spread each, just for one move in a multiple, from 25 to 26, from 26 to 27. So you can really see how the multiple is so important. And that's the issue. That's the challenge that comes when you're looking at stocks. Looking at Netflix, the issue you have is, if you pay too high of a multiple, you can really get burned. Let's see what the multiple was then. So, paying this upper 50, 60 multiple, and then the market spooks, and you get these huge drawdowns. Obviously, there was a lot going on, but the market's a lot more likely to sell things off if the multiple's high. So hopefully that was helpful. I hope that made sense. Let me know what you think about it. And I'm happy to do more videos like this if people like it.